Good morning everyone, my name is LIVIA YUU. Today I will present my research entitled Dynamic Relationship between Oil Price Return and Stock Market Return in Major Oil Importing Country, Impact of Energy Crisis on Portfolio Diversification from 2015 to 2026. Crude oil is one of the most important energy resources in the global economy. Many countries rely heavily on import oil to support economic activities. As a result, change in oil price can affect stock market performance. Therefore, understanding the relationship between oil price and stock market is important for investors, portfolio managers, and policy makers in managing risk and improving portfolio diversification. Under a background study, this study focused on 5 major oil importing countries, which is China, United States, India, Japan, and South Korea. Throughout the sample period from 2015 until 2026, several major global events affect oil price, which including oil price collapse, global economic recovery, US-China trade war, COVID-19 pandemic, Russia-Ukraine war, global inflation and interest rate hike, and US-Iran conflict. There were several issues that caused problem statement. First, oil prices have become increasingly volatile due to global economic and geopolitical events. Investors face difficulty in finding effective portfolio diversification strategy during energy crisis. Different oil importing countries may react differently to oil price fluctuation. Lastly, the relationship between oil price return and stock market return change over time and remain uncertain under different market conditions. This study addressed 3 research gaps. The first gap is the previous study paid limited attention to global energy crisis event as moderating factor. The second gap is that most studies only examined previous before 2023 and did not include recent events such as the US-Iran conflict in 2026. The third gap is that previous study focused mainly on statistical relationship and provided limited practical recommendation for portfolio diversification and risk management. There are 2 objectives in this study. First, to examine the dynamic relationship between oil price return and stock market return in major oil importing countries during global events. Second, to evaluate the portfolio diversification impact of oil on stock market during global event. In addition, the study answered 2 corresponding research questions regarding dynamic relationship and diversification benefit. The 2 hypotheses were developed. First, the correlationship between oil price return and stock market return is dynamic and varies across different market conditions. Next, the lower correlationship between oil price return and stock market return enhance portfolio diversification. This is the statistical framework for the study. Oil price is looked as an independent variable, while the stock market return in major oil importing countries is known as a dependent variable. This study is based on modern portfolio theory. According to the theory, investors can reduce portfolio risk through diversification. Diversification becomes more effective when asset has lower correlation. This study used secondary data collected from XIN library database and Yahoo Finance. Daily closing price for oil price and stock market index from December 2014 until March 2026, while the study sample period were from January 2015 until March 2026. The oil price return and each country's stock market return were calculated by this formula. 2 analytic methods were used in this study, which is descriptive statistics and DCC-GASH model. The descriptive statistics show several important findings. First, crude oil achieved the highest average return but also the highest volatility. Among the stock market, the United States recorded the highest average return while China recorded the lowest. Japan had the highest standard deviation, indicating the highest market volatile and highest risk. South Korea showed the highest downside risk because it has the most negative skewness and highest kurtosis. These findings suggest that different countries has different level of sensitivity to oil price fluctuation and global events. Next, I will continue with the discussion of result of DCC-GASH. For Japan, the average correlationship is 0.1070. The highest correlationship occurred during the oil price collapse, while the lowest correlationship happened during the global inflation and interest hike. For China, the average correlationship was approximately 0.1374. Highest correlationship happened during period of pandemic COVID-19. The lowest correlationship happened when US-Iran war started. For India, the average correlation ship was 0.1130. The highest correlation ship happened when the oil price collapsed, while the lowest correlation ship happened during the US-Iran war. For South Korea, the correlation ship stayed roughly around 0.0994, flat throughout the sample period. The highest correlation ship happened when the global recovery because of the use of COVID-19 vaccine had succeeded. The lowest correlation ship happened due to the geopolitical factor. For US, the average correlation ship was 0.2678. The highest correlation ship happened when the oil price collapsed. The lowest correlation ship happened due to the rising interest rate and change in market condition. The result of the study had generated several recommendations for investor and portfolio manager. First, investors should adopt dynamic portfolio diversification strategy and regularly rebalance their portfolio. Second, investors should allocate more investment to market with lower oil stock correlation ship to achieve better diversification benefit, especially South Korea during energy crisis. Third, investors can use hedging instruments such as energy ETFs to offset some of the loss in energy-sensitive equity market. Last, risk-based portfolio allocation should also be considered. For policymakers, two recommendations are suggested. First, government should promote investment education and promote public awareness of diversification and risk management. Second, government should strengthen national energy security by developing renewable energy and expand strategic petroleum reserve to reduce dependency on imported oil. In conclusion, both Hypothesis 1 and Hypothesis 2 are supported. This study found that oil price return and stock market return are dynamically related. Global events significantly influence the strength and direction of this relationship. Lower oil stock correlation ship provided stronger diversification benefit. Although almost all the countries provided positive relationship, however, among the 5 countries studies, South Korea, Japan, and India offer better diversification opportunity than United States and China because of the lower correlation ship. Therefore, investors should adopt flexible diversification strategy, while policymakers should strengthen their energy security. That's all for my presentation. Thank you for your listening.